it looks like the Federal Reserve is setting the stage for a pretty major market shift. And you know what? All the signs are pointing towards 2026. So today, we're going to break down exactly what those signals are and what they could mean for all of us.
But first, just a quick and important reminder for everyone, this is all for educational purposes. It is not financial advice.
So what's all the buzz about?
Well, it really seems like the Fed is sending out some serious signals that a big change in the economic environment is coming. Let's dig into what's happening and figure out what it could mean for the next couple of years. Okay, so the very first piece of this whole puzzle is the Fed's upcoming meeting on December 10th.
And honestly, the market has pretty much made up its mind on this one. There's a whopping 89% probability that the Fed's going to announce an interest rate cut. Now, because this is so baked in, the cut itself probably isn't going to cause any major waves.
We're talking about a modest quarter-point cut, which would bring the rate down from 4% to 3.75%. This really shouldn't be a shock to anyone. It lines up perfectly with what the Fed themselves projected back in September. They're basically just sticking to their own script. So here's the thing, and this is really the crucial point. Since everyone already expects the cut, any big market moves are going to come from the new information. We have to look at the Fed's updated projections, especially the ones looking all the way out to 2026. That's the real story here. And you know, this expected rate cut, it's actually part of a much bigger policy shift that's already kind of quietly started happening, the end of monetary tightening.
Now, to get this, we need to quickly define quantitative tightening, or QT. It's just the fancy term for the Fed pulling money out of the financial system to cool down inflation, the exact opposite of printing money. And that whole process, it officially stopped on December 1st. So why did it stop? Well, the financial system was starting to show some real signs of stress. It actually forced the Fed to pump $13.5 billion in liquidity just to keep things running smoothly. This was the second biggest injection like this since the pandemic, and it was a crystal clear signal that the markets just couldn't take any more tightening. Which, of course, brings us to the next logical question. If the policy of pulling money out of the system is over, then what policy is next on the agenda? Well, the next phase is quantitative easing, or QE. Yep, the polar opposite of QT. This is when the Fed starts increasing the money supply to get the economy going again. The widespread expectation is that this policy is going to make a comeback, probably starting sometime in 2026. But there's another major factor that's driving this timeline, and it has everything to do with a big change in leadership that's coming to the Federal Reserve. Just take a look at this timeline here. The current Fed chair, Jerome Powell, his term officially expires in May of 2026, so we're expecting a new nominee to be announced in early 2026, which really sets the stage for a huge transition. And here's why that timing is so important. The leading candidates to replace him are expected to be more dovish. Now, in the world of central banking, dovish just means they're in favor of easier monetary policy. Think lower interest rates, more stimulus, basically more QE. This would be a really significant shift in policy. This whole situation creates this fascinating dynamic that people call the shadow Fed chair. Once a new nominee is announced in early 2026, the markets are going to start paying way more attention to what they say than to what the current chair, Powell, says. Their words will carry so much weight because everyone knows they're the ones who will be in charge soon. Okay, so we've covered a rate cut, a pivot from pulling money out to putting money in, and a big change in leadership. Let's try to connect these dots and see the bigger picture they're painting for us. So let's put it all together. The rate cut that's coming, it's really just the beginning. The whole era of monetary tightening has been forced to end because of stress in the banking system, and that paves the way for a return to easier money, probably in 2026, which will be ushered in by a new, more dovish Fed chair. And all of this brings us to one final, really big question. We're seeing a clear shift towards policies that are designed to stimulate growth, but these are the exact same policies that can fuel inflation. So as this new era of easier money gets closer, the real challenge is going to be managing that incredibly delicate balance between boosting the economy and keeping prices from spiraling out of control. Thanks for watching this economic update on 15-Minute Investor.